Good day, fellow investors. Rio Tinto is a great stock to analyze because not only it's a great business, but it also gives an indication of iron ore, copper and aluminum prices that consequently give an indication of where is the current economy, where is the current economical cycle, and therefore great investment insights. So I hope you enjoyed this Rio Tinto analysis video. And Rio Tinto really is a cyclical stock, so we have to understand the cycle, and as Peter Lynch says, there is the right time to invest in Rio Tinto and all cyclical stocks. So I'll put the link to this 6 stock categorization video in the description below. So when this video finishes, make sure to click on that video and watch that to understand even better what Rio Tinto as a cyclical stock is and how to make money by investing in cyclical stocks. If you enjoyed this stock analysis and this investing mindset, please smash that like button to support the channel and consider subscribing if you haven't. So let's take a look at Rio Tinto's stock, and we can see that over the long term with a big dividend, it did really well, up 8 times over the last 30 something years. With the dividend, with reinvested dividends, it did beat the S&P 500. But you must understand this is a typical cyclical stocks, and there are constant ups and downs, booming in times of exuberance like it was the case in 2008. We are still 50% down from the 2008 peak, crashing when the world is about to end. And if you look statistically, the world is usually about to end every 7-8 years. So now we are again in a good cycle period. So the world was about to end for a brief moment in March 2022, then again November 2021, but now everything is good. So the next time the world is about to end, then it's always a good time to buy a company like Rio Tinto, because it is a compounder, and you can see that no matter the ups and downs, it compounds, it increases the dividend, it makes money, and therefore it is a good business to own for the long term. But of course, you will have much better returns if you buy in the negative parts of the cycle than buying in the cycle peaks. And that's exactly what I want to discuss. Explain the cycle, explain Rio Tinto, and explain how to know when and where we are in the cycle. For that, we'll look also into details for iron ore, copper, and aluminum. But let's dig now into fundamentals, which is something that really messes, especially with novice and intermediate investors. If you look at Rio Tinto now, the fundamentals are staggering. So Rio Tinto, if we look at the price-earnings ratio, is below 6, yes, below 6, and the dividend yield is 10%. 10.6%. And then you might think, Sven, in this world of zero interest rates, in this world where the S&P 500 gives me 1.2, 1.3 dividend yield, Rio Tinto gives 10%, which means it must be a great buy. Well, not that fast. Cyclical stocks are the best buy when the fundamentals look terrible, and are the worst buy when the fundamentals look amazing. This is counterintuitive, but it is like that. If we look again at Rio Tinto's fundamentals, now the return on capital employed is a staggering 44%, free cash flows 18 billion, dividends 16.8 billion, which is a staggering amount. But then you might think, okay, Sven, tell us why it is now not that a great buy, but it is a better buy when things look ugly. Well, because with cyclicals, but in general with the cycle, with economy, with everything changes. If we look at Rio Tinto results, just look at 2020 compared to 2021. So free cash flows and total dividends almost doubled in 2021. And these are the numbers that you now see in the price-earnings ratio. The total dividend per share doubled, so you see that as 10% return. But if iron ore, aluminum, copper prices return to 2020, then it halves. And that is a typical example of the cycle and investing in cyclical stocks. Because if we look at commodity prices, yes, those have been great in 2021. Iron ore, aluminum, copper, and those prices are still high. Iron ore went down here, but already recovered from the lows in November, and now it is already higher. So Rio Tinto made a lot of money here. This is what is included in the 10% dividend. Made less money here, but as it already rebounded, will still make good money. But if we look over 5 years, you can see really this as an outlier, and we'll discuss later how to know when prices, long-term prices, are high or very, very low. There is a simple indication method that I'll share with you, and that is the cost curve. If you look at the cost curve for iron ore in this case, you must understand that the marginal producer sets the price for the whole industry. So this is the demand, and then this guy here with the highest cost but necessary to satisfy demand sets the price for everyone else. So if demand drops just a little bit, recession, China slowing down, whatever, if demand drops to, let's say, this is just a 5% drop in demand in relation to supply, you can immediately see how iron ore prices drop to 60 per ton, because this guy then creates the marginal price and the price for everyone. And that's clearly explained also by the volatility in iron ore prices. So 2017 everything was sluggish, 46 per ton. 2021 huge demand, 210. Then supply comes around and we are below to 83, and then again up to the current levels. And this is again an interesting factor to look at Rio Tinto, because China takes 71% of the iron ore imports, and therefore Rio Tinto is also a good thermometer for knowing how things are going in China. Nevertheless, keep in mind this is a cyclical, and that is also represented in free cash flows. So yes, last 12 months they made 17 billion in free cash flows, but I would argue on average they will make 10 billion. Bad years they will make 5-6 billion, and that is what you have to take into consideration when it comes to valuation and investing. And you can see how those cash flows constantly go up and down, really high in good times, but not that great in bad times. And of course, if China slows down, then Rio Tinto will slow down too. And Rio Tinto is a covered stock on my research platform, more about that later, and I have taken for valuation purposes an average dividend of 8 billion per share, which I think is conservatively the average to take for valuing Rio Tinto. With a growth rate of 3%, as they don't invest much for growth, then if I expect a dividend yield of 7-8%, which is pretty high, but for cyclical stocks you want to be rewarded for owning them, the intrinsic value for Rio Tinto is 90 billion. The current market cap is 122 billion, so it's not far from my valuation. Of course, if things grow faster with inflation, then for a 12% return, which is my expected return, 12.5% here, we see that it is pretty fairly valued in the best case. But in the worst case, when all things look ugly and there is no growth, then it's still pretty much possible for it to crash, let's say 50%. Sounds too much? Well, look at where it was trading in 2020. So 50% down, it's pretty easy and possible. You just need to wait for the right time to invest in such cyclicals. And if you look at the free cash flows, you can see that all the free cash flows are just thanks to increases in prices for 2021. And this is my strategy, this is my table on my research platform, and therefore I have added Rio Tinto to just watch it. And when it comes to something that I consider a margin of safety, it comes there once or twice in a lifetime, then I might consider having Rio Tinto. So you might want to check my research platform. There is 20 to 30 stocks that I cover in that, and then wait for the right time to really nail that low risk, higher reward. And Rio Tinto is definitely a business that offers low risk, high reward investing opportunities here and there. Of course, when something is bad, iron, copper, or aluminum, then I like to dig deeper for smaller producers where the risk is still low, but the upside might be even higher than the big conglomerate that Rio Tinto offers, and for that I have it on my watch list. Now, really something to explain cyclical stocks and investing in cyclicals is the cost curve. This is explaining, okay, this guy sets the price, this is for copper, aluminum is much more flat than copper, and how to invest? Well, it's pretty simple. If you want a margin of safety, then you have to buy these stocks when the price of the metal is around 75% of the cost curve. The cost curve will likely go up with inflation in 2022, so this will have to be adjusted on the higher side in the future, but when copper prices will be, I don't know, 2, maybe on the new cost curve, 2 point something, that will be a low. Analysts will always imagine same good times to last forever and bad times to last forever, and that will allow for low prices, as we have seen with Rio Tinto stock prices. Here they expected great times to last forever, here they expected bad times to last forever, and that's typical for Wall Street, and that's an advantage we have to take. Also, iron ore, when the price hits 60, you know that it is not sustainable for it to go lower over the long term, and that's the best time to buy for long-term investments. Aluminum is a little bit more complicated, but still, when the price is lower than where it is now, you know that you are looking at a good buy. So this is investing in cyclicals. Don't forget to check the Peter Lynch video, check also my research platform if you are interested. Thanks for watching, and I'll see you in the next video.